Welcome to the Nadex Application and Strategy webinar series presented by Daryl Martin with ApexInvesting.com. Today what we're going to do is we're going to talk about risk and leverage. And specifically we're going to go into undefined risk leverage versus defined risk leverage. Leverage increases the ability of your dollars to make or lose money. No leverage, an example would be putting up $100 to buy something that is priced at $100. If it becomes worth $150, you've made $50 on a $100 investment. That'd be a 50% return on investment. Leverage, on the other hand, would only require you to put up, say, $50 to buy something that's priced at $100. If it becomes worth $150, I still only make $50, but I made it only using $50. So I made a 100% return on my investment. Leverage allows you to use less money to place a trade, therefore potentially increasing either the risk or the return on investment per dollar invested, so you can do more with less. There are two types of leverage. There's leverage with uncapped risk and leverage with capped risk. So for example, if I were to put up $50 to buy something that has a value of $100 and it becomes worth $0, I would not only lose the $50 I put up, but I would lose another $50. If I don't have the $50 in my account, I would get what is called a margin call from my broker. And what they would do is they'd tell me to send the money immediately. All right? Leverage with capped risk works a little bit differently. I still only have to put up $50 to buy something that has a value of $100. But if it becomes worth $0, then I would only lose the $50 I put up. I would not lose the entire $100 that the instrument is worth. This is because my risk is capped to the amount of money that I had to put up. The benefit with capped risk is only $50 of the value, and the $100 instrument is at risk. The remaining $50 of value, from 50 down to 0, is not at risk. So what type of leverage would you rather use when trading? Leverage with uncapped risk, that can risk more money than is even in your account, or leverage with capped risk, which only risks the amount of money that you put up. Let's look at a couple examples of what a margin call is. And this is, again, with undefined risk leverage. Let's say you have $700 in your account and you put up $500 margin, which is 50% of the value of the 10 shares of, say, stock that you're buying that are worth $100 per share. So the total value of the shares is $1,000. You're putting up $500, so 50% margin. Let's say you then lose $200 and just 1 cent on the trade. What's going to happen is you're going to get a margin call immediately. In addition, if more than $700 is lost, the amount in your account, you're going to actually owe money to the broker and have no money in your account, as you have lost more than is in your account. So if a margin call happens, one of three things are going to take place. One, they're probably going to automatically close your trade, but they're not required to. Okay? If the market moves fast, or let's say it's between open and close, they may not even have time to close it. So you could easily lose more than the total amount in your account, including the margin that you put up. And that's actually why they have you put up margin, because they're hoping that that will cover any movement before a trade is closed. They may call you to inform that additional funds or collateral, such as bonds or stock, must be deposited, or cash, so wire transfer, things like that. Or they're going to close out the position, or they may allow you to close out part of the position or other positions you have to free up some capital, if any is available. So that way your account balance is not negative with the margin and the loss. Let's look at another scenario. Actually losing more than is in your account balance. If you have, say, $2,000 in your account and you put up a $1,000 margin, 50% of your account size, to buy just one futures gold contract, valued at about $157,000 in buying power. Well, let's say the market then gaps, a fast market move down 30 points because some huge news announcement comes out, and you've now lost $3,000. What's going to happen is you're going to get a margin call stating that your account balance is negative and that you need to pay $1,000 immediately, meaning there's nothing in your account, you have to pay $1,000. That's because you trade with undefined risk leverage. Well, unlike the non-defined risk futures and Forex products, all products on Nadex have capped risk. The margin or capital that you must put up to place the trade is always the maximum risk whenever you trade on Nadex, meaning you never can risk more than you put up to place the trade. So let's look at a no margin call scenario using Nadex. If you have $2,000 in your account and you put up $300 margin, which is only 15% of your account size, to buy 10 Nadex gold future spreads valued at $150,000 in buying power, and the market gaps and moves with just a fast, furious down move, 30 points against you, you'll only have lost $300. Plus, you have until expiration of the Nadex spread for the market to come back, so you can potentially actually still make a profit. Well, how is this possible? Well, through the use of Nadex spreads, you can limit risk and have more time to be right about direction. Nadex spreads can be thought of as a box. That's actually why I call them box spreads. The spread creates a box of opportunity. This box gives you the ability to have high effective leverage with limited and 100% defined risk. For example, here's a box spread on gold. So gold being priced right now around 1573, and the box spread is from 1570 up to 1620. Well, it's at 1573, and that's 3 points right there. So that's, and if I did 10 spreads, that's $300 of risk, with the ability to make a potential $4,700 of profit, depending on how far the market moves up. If the market were to crash and fall down, I'd still only bid down $300. But let's say before the spread expires, it comes back up. I actually can still make money. In any other scenario, this would have been a massive loss. But with Nadex gold spreads, I actually have the defined limited risk leverage. To find out more about how the box spreads work, watch our other videos. Also visit us at apexinvesting.com to learn more about how to trade Nadex spreads and binaries.